Hello everyone. So, today our main subject will be about market makers. Especially, what is a market maker? So let's get going. A common question investors might have concerning the market would be, how is it possible to always be able to trade? Or how is it possible to always be able to buy and sell whenever you want? The answer to this question is a market maker. This, essentially, I know it seems silly, but is the guy who makes the market. So, let's switch to a quick table of contents. I tried to make it a bit more simple this time, so the video would be less long. So, first off, we will try and understand what a market maker is, get the textbook definition, and understand the in and outs of it. Then, our question will be how? How do market makers work and how do they take risks or not? Then we will try to understand how market makers survive and work in this industry. Finally, our main question will be why. Why do market makers exist? And why are market makers essential to the global economy? So, first off, let's get the textbook definition of what a market maker truly is. But soon we will get to understand what it was. Because I think what it was sometimes can be a bit more interesting. But if I had to answer the question of what it is now, it is an algorithm owned by investment banking that updates bid and ask rules, like Credit Suisse, JP Morgan, or Citadel, for example. At the most basic, you can think of a market maker as someone turning a computer on in the morning and turning it off in the evening, hoping there is more money at the end of the day. So, market makers provide immediacy to other traders that don't have the time nor patience to stick around all day looking at a chart that is moving. Essentially, we need someone to provide the luxury to be able to buy and sell whenever we want. This someone, nowadays, unfortunately, is an algorithm. So, I think it is truly interesting to look at this picture and to get back into time, especially in the 80s. This picture is a picture of the New York Stock Exchange in the 1980s. Personally, when I look at it, I see a lot of people, and to me, it looks a lot like a market. I know it could sound vague, but looking at the market, the difference between a market and this picture of the New York Stock Exchange doesn't really differ apart from their expensive suits, I guess. The only difference is the two-sidedness. The fact that in the trader economy, in the New York Stock Exchange, these people are always able to buy and sell at the same time. I don't think in a market where you buy, I don't know, fish or vegetables, you would be able to sell the same fish you just bought to the same market. Two-sidedness is thus essential in a stock exchange. Furthermore, when going through time, we finally end up in the 90s. This being a picture of the Hong Kong Stock Exchange in the 1990s. I think a very interesting thing about this picture is the lack of colors we see and the ratio towards human versus machines. People disappear and machines slowly take their place. Finally, this is what a market maker may look like today. Just servers, maybe just a bug flying, but not really a human interaction. A market maker is a firm or individual that actively provides liquidity in financial markets by continuously offering to buy and sell securities at publicly quoted prices. Market makers help facilitate trading by ensuring that there is always a counterparty available for investors who wanted to buy or sell an asset, such as stocks, bonds, options, or even cryptocurrencies today. They profit from the spread between the bid price, the price they're willing to buy at, and the ask price, the price they are willing to sell at. So let me explain. In short, market makers are the intermediate players that provide a liquid market. They make money by the profit generated out of the spread, the difference between the bid and the ask price. Let me give you an example. It is publicly quoted on the New York Stock Exchange. I would thus provide a bid price of, for example, $900. Thus, I will also give to people an ask price of $902, for example, because of course the ask price always has to be a bit higher than the bid price for me to be able to make profit. The difference between the two we would call the spread, being $2. The spread being the profits we take. This means a market maker, this means a market maker in theory always will be able to make profit. If he sells at a lower price than the market. If he buys, if he sells at a higher price than the actual price on the market. And if he buys, he will buy at a lower price than the actual price of the market, thus always doing some kind of profit. We could, we could also deduct that the price of the company A share would be about $901. This will mean that if he sells at a bid price, it will offer him $1 of profit. And if he buys at the ask price, it would give him $1 of profit. So this is an example of a probability theory. I give you a lot of examples so to be sure that you understand the basics of the bid and ask price and the spread perfectly. Because it is essential to understand how market makers function and work to understand their role in the financial market. So, imagine I have a dice game. My game is that every variable, every number you roll from 1 to 6 will give you the equivalent amount in dollars. So, if you roll 1, I will give you $1. If you roll the number 4, $4, etc. Assuming it is a nice and honest dice, we could ask ourselves, what is the value of this bet? Let me explain. So, our calculation would be the theoretical value equals the variable divided by the probability being 1/6. Because you have 1 on 6 chances to hit 1, 2, 3, 4, 5, or 6. The answer would be 21 divided by 1/6, resulting in $3.50. This would mean that if you play enough times, and if you offer this game to enough people, at the end of it, you would also, at the end of it, you would always be able to profit, even slightly. Because normally, 50% of the people will get 1 to 3 and does not make profit because the price to enter the bet is $3.50. The other half would make some profit and be happy about it, but they would have to pay above 4, 5, or 6. So, imagine I am a market maker in dice rolls. What would be my bid and ask spread to make profit? I have a few examples here, being $3 and $4, $3.25, $3.75, $3.49, or $3.52. The trick is there is no right answer, because you have to look at the different goals you have as a market maker. The first one being to attract customers. This means that you have to be competitive with other market makers or traders. To be competitive with other market makers, you not being the only one on the market, means that you have to be competitive with your prices. I think it seems quite self-explanatory that if you are able to buy, for example, the S&P for $100 on one exchange from a market maker, and at $98 at another exchange, you would choose the cheaper one because the stock doesn't change. So, higher prices, more people. So, higher prices, less people. Tinier prices, cheaper prices, more people. Number 3 would be to create enough potential profit to fairly compensate you for the risk you are taking. This is normally the moment when you would ask me, what are the risks a market maker has to take? There are actually a lot of them. So let's begin. What are the risks a market maker has to take? The first one would be inventory. So this occurs when a market maker holds a large position in an asset and the market moves against them, resulting in a potential loss. For example, if a market maker accumulates a large inventory of a declining asset, they may face significant losses when selling it. Number 2 would be spread. The spread is the difference between the bid and the ask price quoted by the market maker, as we said before. In volatile markets, spreads can widen, reducing profitability. Additionally, if the spread is too narrow, the market maker might not cover the cost of providing liquidity. So, for example, if a market doesn't move a lot, the bid and ask quote would be a bit higher and a bit lower. Normally, in normal circumstances, the price isn't liquid enough or volatile enough to move out of these price ranges. But imagine the price, for example, on a cryptocurrency, moves a lot. The market maker doesn't want to put his bid and ask spread between those two, because imagine you want to buy and you buy at this moment, and 1 second later you can sell it at the same market maker. You can sell it to the same market maker at a higher price. He would lose a lot of money because we are not talking about some few dollars. we're talking about millions or billions of dollars every minute or second. This would mean that he has to take larger and wider spreads to accommodate for the risks and the volatility he is taking in a specific market. This would thus mean the prices are higher. This is one of the many explanations why getting in crypto sometimes can result in very high fees because the market makers, there not being a lot of them actually, because they don't want to take those risks, can have some kind of monopoly, but also want to try and not take too many risks, so have very wide spreads. Since crypto can move a lot of points in just a few seconds. In periods of high volatility or uncertainty, market makers may need to widen their spreads to protect themselves against rapid price changes. While wider spreads can increase potential profits, they may also discourage trading activity, leading to lower trading volumes and reduced overall profitability. So, number three would be counterparty. Counterparty risks refer to the risk that the party on the other side of a trade defaults or fails to meet their obligations, potentially causing financial losses for the market maker. A market maker sells shares to a counterparty, expecting payment. For example, a market maker sells shares to a counterparty, expecting payment. If the counterparty defaults or delays payment, the market maker still needs to fulfill obligations to other clients, potentially causing a cash flow issue or loss. For example, me being a market maker, I have someone of the one side of a trade who wants to buy 1,000 shares of Tesla. I have someone else who wants to sell his 1,000 shares of Tesla. For me, it is an easy trade. I have nothing I have nothing to do in the trade. I am just the party in between who takes the money, takes a fee, and sells it back. The problem is sometimes the one person that wants to sell the 1,000 shares of Tesla doesn't want to do it anymore because of any kind of reasons. There are a lot. The problem is the other person still wants to buy these 1,000 shares. This results in the fact that I have to dig in my treasury to buy these shares myself at publicly quoted prices, resulting in financial losses most of the times. So, while less frequent in regulated markets, it remains a significant concern for market makers, especially in volatile or over-the-counter OTC markets. The final one would be liquidity. Liquidity risks refer to the challenge market makers face when they cannot buy or sell assets at their desired prices due to a lack of market participants or insufficient market depth. This risk becomes particularly pronounced during periods of high volatility or market crashes, where trading activity may surge but liquidity evaporates. During a sudden market crash, there is a surge of sell orders. As investors panic, however, buyers disappear, and market makers are forced to absorb large quantities of inventory. To offload these assets, the market makers may need to sell at much lower prices, resulting in other financial losses. If a market crashes or has a correction, most or most of the people will try and sell, FOMO or whatever. But the fact is, me being a market maker, I have no one on the other side who is able to absorb all this selling. No one wants to buy anymore. So I have also again the need to go dig in my treasury to absorb all this liquidity. Since everyone is selling, I have to buy all the shares they are selling. So liquidity risk is a significant challenge for market makers, particularly during volatile periods or market crashes. The instability The inability to exit positions efficiently can result in large losses, requiring robust strategies. Requiring robust strategies like dynamic pricing, diversification, and hedging to manage the impact effectively. When a crash happens, a lot of people want to sell. Thus, I have to buy all the people. Thus, I have to buy everything like commodities, stocks, or bonds that the people are selling. But I have no one on the other side that is able to absorb all of this selling and is able to buy everything that is selling right now. This means I still have to find customers to buy my securities, bonds, and stocks. I thus will need to be competitive and have much lower prices to be able to still offload everything and all the securities I have in my treasuries. So, one of the questions that remains would be how do they try to avoid those risks? To manage these risks, market makers employ a variety of strategies that allow them to operate effectively, even in the most volatile market conditions. You probably already heard of dynamic hedging. Everyone is actually or trying to hedge his positions in the market. Market makers use dynamic hedging strategies to mitigate inventory risks. This involves continuously adjusting their positions to offset potential losses from adverse price movements. For example, if a market maker accumulates a large inventory of a specific asset, they might take an offsetting position in a related asset or use derivatives like options or futures to hedge against price declines. Me, for example, being in the cryptocurrency market or traditional stocks, I will invest in gold to try and hedge my position against a possible crash that will happen, for example, with the tariff war of Trump right now. Gold is going up while everything is going down, this mitigating my losses. An example would be that a market maker holds a large inventory of stock X, whose price has risen sharply. To hedge against the risk of a price decline, the market maker could 1. Short stock X futures, which will profit if the price of stock X falls. 2. Would be to buy put options on stock X, which increase in value if the stock price declines. And finally, take a position in a correlated asset, for example, competitor stock, or an ETF that tracks the sector to offset potential losses. The most basic example of this will be to short and long the same asset. I take a short position on Tesla and a long position on Tesla. This would then result in the fact that I will all the time be at no profit or no losses, break even. An example would also be a lot of money in Boeing. I would put some of my profits in Airbus, his competitor, so that if he has a crash, Airbus will probably profit out of it. And I would still be able to profit or make a slight hedge against the crash just I just witnessed. A few interesting books about hedging would be Dynamic Hedging from Nassim Taleb or from Nassim Taleb. Nassim Nicolas. Nassim Nicholas Taleb is a Lebanese-American essayist, mathematical statistician, former option trader, etc. His work concerns problems of randomness, probability, complexity, and uncertainty. You've probably already heard of the term black swan, coming directly from Nassim Taleb. He advocates what he calls a black swan robust society, meaning a society that can withstand difficult to predict events. He proposes what he has termed anti-fragility. In systems, that is an ability to benefit and grow from a certain class of random events, errors, and volatility. For example, 2008 crash, 2001 Twin Towers, 2020 COVID. He advocates the fact that we could try and make a robust society that wouldn't be as much influenced by all these random things happening and creating most of the times crashes in the financial market. Other books would be Option and Volatility from Sheldon Natenberg and Trading Options Greeks. This one I am actually reading right now to try and learn Greeks more efficiently. The other ones are maybe a bit difficult, at least for me, because it is very mathematical. If you want to, please go on. Most of these books you are able to find on the internet as PDFs for free. So, dynamic hedging is a critical tool for market makers to offset inventory risk by continuously rebalancing positions using related assets or derivatives. While it helps protect against price volatility, it requires sophisticated strategies and incurs costs. My example with gold is very basic and probably doesn't work most of the times, unfortunately. Making effective implementation essential for managing risk and maintaining profitability. Spread management. Effective spread management is crucial for maintaining profitability. Market makers dynamically adjust the bid and ask spreads based on market conditions. In volatile markets, they might widen their spreads to account for increased risk, for example with the crypto market, and reduce liquidity. Conversely, in more stable markets, they may narrow the spread to attract more trades and increase volume because the prices would be way cheaper, being a good competitive advantage. A wider spread increase. A wider spread increases the profit per trade but may reduce trade volume. A narrow spread increases trade volume but reduces profit margin per trade. A wider spread means less people want to buy, but if they do, you will profit more. Tinier spread means a lot of people will be able to buy and want to buy your asset, but you will profit way less. Like every market, this is price and demand. You have to find your right equilibrium. Finally, algorithmic trading. So, advanced, advanced algorithmic trading systems are essential tools for modern market makers. These algorithms can execute trades at high speeds, react to market changes in real time, and manage large volumes of trades with minimal human intervention. By leveraging machine learning and AI, this system can also anticipate market trends and adjust trading strategies accordingly. One of the fundamentals of algorithmic trading nowadays is called high-frequency trading. This being a true rabbit hole that if you want to, you can look towards on YouTube or certain PDFs on the internet. I will not go too far in depth about this subject because my presentation already is quite long. So, one of the fundamentals is algorithmic trading. Most of the biggest market makers, Citadel Securities for example, are high-frequency trading computers placed near the New York Stock Exchange to gain milliseconds. I will put a video in the description talking about it. That's to me quite interesting and may get you into a new universum of that is to me quite interesting. So here are some other examples, but I think my examples are already long enough, and as a matter, it is just to try and explain to you that there is a lot of risks and a lot of techniques to try and avoid those same risks. For example, risk limits, diversification, liquidity provision, stress testing, and you have a whole nother, but it's boring, and I guess we have no time for it today. So, how do market makers manipulate commodities? I could give you different definitions and explanations on the subject concerned, such as spoofing, for example, but it seems to me that real-world examples would be much more telling. The Black Monday crash, which occurred on October 19, 1987, is one of the most infamous stock market crashes in history. By the end of the Black Monday, the Dow Jones Industrial Average had dropped 508 points, or 22.6%, 22.6%, marking the worst single-day percentage drop in history. While many factors contributed to this, market makers caught in the feedback loop and overwhelmed by selling pressure played a critical role in enhancing the crash. This is an example of the Dow Jones. As you can see, the crash was terrible and it all happened in a matter of days. Still, I think talking about ETFs, like my past presentation, if you invest long term, the effects of all these crashes will have nothing to do with your portfolio. You just have to withstand them and keep investing. So, Black Monday 1987. If you want to, you can read this text. I think you can do your own due diligence on the Black Monday. But the interesting part about it, and the link I tried to put between market making and the Black Monday, is the fact that everyone was selling, triggering new stop losses from other institutions or people, market makers not being able to find any buyers, simply stopped buying the securities of the whole market. So, imagine you are in the 80s, in the Black Monday, and you wanted to sell everything you had because you FOMOed or you were scared of the condition of the market. At a certain point, you wouldn't be able to do it anymore. Other examples of crashes that are probably an effect of market making and the feedback loop would be 2008 financial crisis, the COVID-19 market crash, or the crypto corrections we are seeing nearly every day actually. Finally, we'll get to the conclusion. So, in today's financial landscape, one of the most essential figures is the market maker. Without market makers, there would be no efficient and fast market. This means you and me could not buy whenever we want. This means it would limit the economic growth of consumers. Limiting the economic growth of consumers, meaning limiting the global GDP of the world. This would result in us being not so far ahead as we are today. Our technological evolution would be, I would say, maybe blocked at the Industrial Revolution 50 years ago. Market makers are essential for the market and essential for the world we are living in today. I would think I would love to thank you for your time and patience and hope you learned something today about market makers and hopefully you will be able to continue your own due diligence and research on the internet afterwards. I wish you a great evening or beginning of the day and I see you next time.